next segment of our agenda for today, I'd like to welcome Rob Promisel, who's a portfolio manager on our Nedgroup Investments Global Property Fund. Last time we chatted to Rob, he was in the midst of a blizzard, if I recall correctly, and the time before that, a heat wave. And then just last week, his president was blaming the Canadian wildfires for his lack of visibility outside the New York apartment windows. But Rob, how do we find you today?
David, it's great to be with you. I really appreciate the editorial intro there. That was colorful, to say the least. Look, we're really pleased at a number of things. In the past quarter, performance was strong in absolute and relative terms, which has really been what we're aiming for, to be consistent over really all time periods. But also, additionally, I'd like to say how pleased and honored at ResCap we are to be working with Ned for 10 years now, having reached our 10-year anniversary with the fund just after a period end in early July.
It's good to know. I didn't realize the decade relationship was up. Maybe we should expect reciprocal gifts in the post. You did mention you potentially coming to South Africa, so it'll be wonderful to see you here in the flesh. Rob Johnson, our head of investments, always reminds us that this is the best fund in the world. And 2 years ago, I was giving him gears about the fund, and he reminded me to stay patient, stay invested, and understand the sector a little better and go back and do my homework. But yeah, so performance has, you outperformed the last quarter and the last year, and it's really, I guess, rewarded those investors that have stayed in the real estate space and the property space. Where's a lot of that consistency and I guess maybe more the attribution from a sector point of view come from?
Right. So if we turn to the sector and regional attribution slide, performance is really driven by exposure in the office sector, where even though the fund is underweight office relative to the benchmark, strong stock selection really drove relative performance in office. And principally, Vornado Realty, which is one of the largest owners of office in New York City, was a major contributor to strong performance in the past quarter. We're really becoming quite constructive on select office markets around the world where there's very strong demand, where supply is limited, and where, as a result of increasing scarcity, landlords are able to exert pricing power, and we're seeing strong rent growth. And New York City is certainly one of those markets. Additionally, the exposure to retail stocks benefited performance in the past quarter. Overweight retail have been overweight necessity-oriented retail, grocery-anchored shopping centers for a long time, and also regional malls. The ones outside the U.S. all have grocery anchors. That drives frequency visitation, but also we're seeing strength in the consumer that has led to regional mall exposure in the U.S. as well, all of which contributed to strong performance in the quarter. And then finally, industrial was a contributor to performance. We're actually underweight the industrial sector due to valuation concerns, but we had good stock selection within industrial that contributed to performance. Principally, we're overweight Segro, which is a UK property company, and underweight Prologis, which is the largest owner of industrial and is the potential acquirer in a pending M&A. So we're positioned well in that regard. On the right side of the chart, you'll see regional contribution. The U.S., which is the largest exposure for the portfolio in the portfolio, was a positive contributor. That's due to stock selection, companies like Vornado and Federal Realty. Continental Europe was a contributor, driven by Unibail, Rodamco, and Merlin Property Trust in Europe. The UK, where we've had an overweight position for some time, was a strong performer in the quarter. We think that there's value in the UK, which is why we're positioned where we are. So those are really the major factors driving performance, David.
Thanks, Rob. And flowing on quite nicely, I guess the next slide on your sector positioning. There's a pie chart there on the right-hand side. Quite glaring is your over and underweight, or at least you're overweight towards healthcare and data centers, you won't be surprised to hear that particular second one has featured a fair amount in our webinar so far today. But what gives you and the team the confidence that these sectors can, I guess, continue to deliver attractive returns even off current levels?
Look, let's not forget that the real drivers for performance in REITs are the drivers for real estate, and that's trying to find very strong situations, very strong demand, limited supply, and real rent growth. In the case of healthcare, which principally for the fund is exposure to seniors housing companies, with very strong demand fundamentals due to demographics, there's very limited supply, and so there's strong rent growth. We expect there to be mid-teens earnings growth for senior housing companies for the next several years, and that's a real important contributor to performance. Data centers is an overweight position for the fund, driven by three primary exposures: Equinix, which is the largest owner and operator of co-location facilities in the world; Digital Realty, which is the second largest owner of data centers in the world; and the NextDC, which is an Australian-listed data center specialist, principally in Australia, but with expansionary plans in the Southeast Asia. We believe that there is a strong earnings growth coming out of the data center companies. Equinix, we think, will be seeing 10% earnings growth for the next couple of years. So, we think that where there's a mismatch between demand and supply, and there's strong rent growth and earnings growth, typically that's a good place to be. So that's the overweight there.
And those supply and demand dynamics are captured in your next slide as well, around the one titled limited new supply and strong earnings growth. And on the right hand side there you have, speaking to the earnings growth, your FFO, which is your funds from operations. You seem quite constructive on the operational outlook for the REIT space. Can you speak a little bit to that?
We believe that in a stable and growing demand environment, that's one leg of the stool for real estate. What's remarkable right now is the reduction in starts and new competitive supply that we're seeing across a range of property sectors, as you can see in the chart on the left, and also across really all the major regions in which we invest. So this is an unusual situation for commercial real estate to see the real ratchet down in competitive supply. And so when you have strong and stable demand growth, which is what we're seeing across most property sectors and markets, not all, but most, coupled with a very benign supply environment, then again, there's going to be increasing occupancy, scarcity of available space, and real rent growth. And that is what we are seeing for certain property sectors. As a result, we think that we believe that the REITs are in a multi-year period of stable mid-single-digit earnings growth, which, as you say, is funds from operations. And you can see the mid-6 to 7% FFO growth that we expect over the next 2 to 3 years for commercial real estate in listed form.
Thanks, Robin. I know you wanted to chat a bit about one of the bigger holdings, Welltower, in your portfolio. I think a lot of people dialed in are familiar with the population pyramids in the likes of Japan, Europe, and North America, and the aging population thematic there. Is this what this position speaks to a little bit? And what is compelling to you guys in the cycle with Welltower?
So Welltower is a $172 billion US billion-dollar market cap company. It's the largest owner of seniors, purpose-built private pay seniors housing in the US, in Canada, and in the UK. It has a very low levered capital structure, less than 3 times net debt to EBITDA. What we find compelling about seniors housing is the aging demographics are really driving an acceleration in demand. The baby boomers are now turning 80. This is 2026 is the front end of the wave of baby boomers turning 80. we expect, and 80 is typically the entry year into private pay seniors housing. We expect over the next 10 to 15 years that the number of people over 80 in the markets that Welltower is active in is going to double. And so demand would naturally follow and increase substantially. We're also in a situation where there is almost negative supply going on for seniors housing. There's virtually no new construction going on. Less than 40 basis points of stock is being delivered as new supply. And there's obsolescence, which actually is resulting in reduction in supply. And so again, going back to real estate 101, strong demand, limited supply, good rent growth visibility. We expect Welltower, which is again the largest position in the portfolio, to see earnings growth, FFO growth, at about a 17% CAGR, compound annual growth rate, over the next 5 years. That's a very strong earnings number, and we feel like we have good visibility on its sustainability, on it continuing being sustainable. So that's why we have the position we do. So the next company I want to talk about is Federal Realty. It's an $11 billion market cap, U.S. market cap company. It's an outdoor shopping center specialist in the U.S. focused on high income catchments. We find that the higher income cohort segments are holding up quite well in this economy. Household income, household wealth is buoyed by stock market, asset price appreciation, and those consumers are spending in shopping centers. And so Federal Realty is really catering to a consumer segment that is showing resilience and growth. As a result, we expect to see tenant demand for Federal centers continue to be strong, for there to be improving rent growth out of Federal centers, and for Federal to see an acceleration in earnings growth as a result. We're expecting earnings CAGR, again, compound annual growth, over the next 3 to 4 years to approximate 10% for Federal Realty. A very strong performer going forward.
Yeah, it stokes a couple of things. I guess the 104 shopping center part of it gives me a bit of, my blood pressure rises a little bit. But then when you speak to mixed use, it evokes a feeling of romance. If I think about, the way European cities used to be designed, you go to the old parts of the cities. In Italy, for example, you have your piazza and then your apartment is above that mixed use component, and your butcher, your baker, your candlestick maker, all within walking distance. You know each other's first names. And that's before this inception of suburbia and driving into work, etc. And even in Cape Town, we're seeing a trend where new buildings going up are really adopting that mixed-use mindset. People they don't want to commute for long periods of time anymore, and they like the idea and the convenience of being in town. And so that's just that's the romantic evocation that I'm getting from that slide outside of the shopping centers. But you want to speak, I know, sorry, I jumped the gun a little bit there. You want to speak about SEGRO. I know you have some interesting views on the logistics space.
Yeah, before we go to SEGRO, let me just give you something on. So we think that Federal has built a really good mousetrap that combines retail with other uses. There is multifamily, which is purpose-built apartments located proximate to their centers. There's office uses. And we find that the environment that is created by mixing these uses together is very complementary to each other. Retail has become an attractive amenity for residences and for offices, and that improves the leasing possibilities for multifamily and for offices as a result. And so we find that Federal is in the placemaking business, if you will, with some very substantial, significant mixed-use properties located around the country. So you're absolutely right, David. I'm not so sure about the candlestick maker, but there might be one in their portfolio.
Yeah, it just seemed to naturally flow from the butcher and the baker. So SEGRO, without further ado, we're really doing kind of a whirlwind through the property space, isn't it? This is a logistics company that, I guess has the data center upside attached to it.
SEGRO is a 12 billion pound sterling portfolio that's listed in the UK. just over 60% of the portfolio is in the UK, 40% is in continental Europe. It has an urban bias to it. For instance, in Greater London, they are the dominant owner in Park Royal, which is the primary business park for distribution into central London, whether it's residential or businesses. And so there's very strong demand for SEGRO's properties. SEGRO's, one of its key strategic assets is the Slough Estate, which is located west of Heathrow. Slough Estate is it's actually SEGRO's first asset. It has become one of the largest data center markets in all of Europe, including the UK. SEGRO has plenty of land and low-scale buildings that could have added density for conversion to data centers. They're very well positioned within the data center market as a result. We think that SEGRO has strong growth potential on its own, but we would note that it has been subject to a potential bid by another listed real estate company, Prologis. So again, I mentioned when we were talking about attribution earlier, the exposure with industrial was beneficial. We were overweight SEGRO, we were underweight Prologis. And that's actually the way the M&A looks like it's happening, where Prologis is looking to acquire SEGRO. They have not agreed terms as of today, but SEGRO is seen as a strategically attractive portfolio for a variety of reasons, including both its core industrial footprint as well as its potential for growing data center business. So, I'd say stay tuned on that one.
Okay, we will stay tuned, Rob. And before we do let you go, someone once told me whether I'm listening to a 2-minute or a 2-hour presentation, the human capacity can remember 3 distinct things. And your final slide here has pretty much 3 bullets, really. I mean, is this what you want the audience to take away? And what exactly are we expressing here?
So look, I want to start with the chart on the right and just remind everybody the role of income in global listed real estate. Income has represented 60% of total returns for global REITs over long periods of time. We're really quite constructive on the income potential for global REITs going forward. The dividends are likely to grow in close parallel with earnings growth. And we're constructive on the outlook for earnings growth for global REITs because the demand supply equation is becoming increasingly landlord favorable. We're seeing a situation where demand is stable and growing across a variety of property sectors and a variety of markets. We're seeing rent growth improve. Some is just increasing and some is accelerating, again, across a range of different markets. Part of the reason for that is there are real constraints to supply today, not just financing costs, but the cost to replace buildings has gone up dramatically over the past 5 years, and rents haven't quite kept pace yet. And so that is fueling a situation where we expect to see supply growth muted over the next several years while demand improves and rent should accelerate. And that is setting up for a very strong operational outlook and earnings outlook for global listed real estate over the next 3 to 4 years. That's why we're constructive.
Rob, I think it's a wonderful place to end. As always, thanks so much for your time today. Enjoy the rest of your summer. And if we don't see you in South Africa in August, we'll catch up with you, I guess we usually say your fall, but we say autumn, yeah? We'll catch up with you in the fall.
Thank you, David. It's nice to be with you.